Hi, I'm Mike Gassewitz, CEO of IAIC. Joining me today is Joel Baker, our Chief Investment Officer. Welcome, Joel.
Hi, Mike. Thanks for having me.
Good to have you on. I thought we'd take a look back at 2022 and Q4 and the year overall. Why don't let's start there. Thoughts on the year at a high level.
2022, what a year it was. It was a year of volatility, and that's one thing we were expecting. And not that we were ahead of the curve, but we just with all the moving parts out there and quantitative easing coming off and COVID and the jacking up of interest rates, all that sort of factored into, we knew asset classes were going to be volatile, and 2022 surely was that. It ranked up there. I must admit it was up there that usually both fixed income and equities don't sell off, but we saw that selling off. So It was a year of volatility for sure. That's a simple way to say that.
It's challenging across the board.
That's right.
So talk about then the sectors, maybe on the equity side of things. What were your observations there?
Yeah, the equity side, it really was a stock picker's market. That's the one thing that jumped out at me. There's always an argument of, passive versus active. And last year truly was one of those years that active management, performed very well. And I think that's going to be the case this year too. We're going to see pockets of sectors that are, ripe for the picking, so to speak, as opposed to just buying the general market. So that's one thing that really jumped out at me, is being able to pick what we think is cream of the crop or quality names, and as opposed to the getting everything that falls onto the same on the same bus. So that was one thing that jumped out at me as a portfolio manager.
And back to our approach, as you mentioned, both the bonds and the equity markets were volatile. Staying in the equity domain, how did clients generally fare, from a volatility perspective compared to the markets themselves?
Yeah, that's a great question. We get that a lot. So they fared very well, actually, because it's really just the kinds of companies we buy. They're defensive in nature. They're blue chip, as we always sort of talk about. They pay dividends. But at the end of the day, the secret sauce here is that we're buying companies that we know are going to be there through thick and thin. So should a recession break out, or should the war continue on, it's going to be those kinds of companies that are there at the end of the volatility. So we stuck to that. It paid off. They were volatile, but nowhere near as volatile as the general market. So
right.
Clients were protected from that angle.
And to your point, the active, passive, the whole aspect there, the fact is that with our approach, it worked. We're trying to reduce that level of volatility by, as you say, picking the blue chip stocks, and that panned out well for us.
Exactly. The other layer there too is we're big fans of diversifying. We always sort of talk about that, and we always sort of preach that, to use that word. But again, being sort of diversified across different sectors again paid off on that defensive strategy. Again, not every sector moves in the same direction and not the same magnitude. So being diversified is another sort of, defensive metric we've built into the portfolio through these volatile times. So.
Any sectors that, say, shined, that outperformed the other, that you'd want to mention?
Not really specific sector per sector. Names within the sector, though, yes. Okay. We saw some names, drastically outperform other names within the same sector. One of the things, maybe looking at it from the other way, is one of the things that maybe hurt us this year was being underweight Canadian oil.
Right.
But we talk about that too. Is a year ago, that space really wasn't looking that good. But bluntly, oil was a bad name a year ago. So oil come roaring back as far as the price of a barrel. The company started to look pretty good from a fundamentals perspective, and we were underweight, no doubt about it. So that's one thing that we look back and, think of maybe something we should have done differently. We have oil exposure outside of Canada, but Canadian oil, we were definitely underweight to the market. So live and learn from that. But that's,
for sure. Mm-hmm. And from an earnings perspective, on the S&P 500, the big players in the U.S., what are we seeing there?
Yeah, that's something we're really keeping a close eye on. So, if we look at a longer term perspective, we're actually right on track, which is kind of weird. So we look back from our existence of IIC, so going back to 1999, and they're actually right on track from a longer term perspective. But to your point, going forward is where the concern is. So when we're looking at 2022, fiscal year ends coming up here, the earnings sort of drop off. just using average numbers, about 5%. The bigger magnitude is next year's earnings. So 2023, it's about 8.5% to 9%, call it double, if you will.
Mm-hmm.
So there is concern, obviously, both on the health of the consumer or the financial stability of the consumer. I think that chalks up to recessionary fears.
Right.
The other side is the companies themselves. They're lowering their guidance, which is usually a sign of their own confidence in the economy. So we're seeing multiples coming back on some of those future earnings. So definitely a slowing trend. Yeah.
So you mentioned the R word, the recession word.
Mm-hmm.
Thoughts on that? I take a step back. The whole point of raising interest rates is to cool the economy to a certain extent. And while we'd like to think the economy is this fine-tuned machine, mm-hmm. it's not. And so any thoughts on that? Go ahead.
Yeah, those are great. Those are great points. So again, to back up maybe two steps, one of the tools we look at is the bond market. We always look at this thing called an inverted yield curve, and that's a session on itself, as you're probably aware. But a real strong indicator is an inverted yield curve is a very strong indicator of a future recession.
Right.
So the other angle is what we look at in terms of these ISM or these PMI numbers. And it's basically the Purchasers and Manufacturers Index. And when that gets to a certain level, again, that's a strong indicator of a recession. Well, both of the radars are up.
Okay.
So when we sort of look at the data like underneath the hood, on average, usually they're sort of beating the recession by about 11 months. So basically they're an indicator of 11 months later, there's going to be a recession. So as we all know, in today's crazy world, a lot can happen in 11 months. So I'm not really saying that it's going to happen or not, but data is starting to sort of show that a recession is quite possible. So again, back to the portfolios. And again, we're sticking to the defense. We're sticking mm-hmm. to the short bond ladders, things like that just protect us should we go into a recession. So,
okay. And so that answers the question. Clients are well positioned for this, back to our approach.
Yep.
And quality names and the right split and from an asset allocation perspective.
Correct.
So then looking into 2023, then, do we see any shifts? Do you see anything that you think maybe you and the
mm-hmm.
team need to do to kind of just put our clients in a better position?
Yeah, a few things just come to mind. So one of the things is our income producing, or some would call it fixed income part of the portfolios. That's drastically different now. So if we were talking a year ago, Mike, the price of safety is kind of what I always call it. The price of safety is drastically higher now. So,
okay.
It's almost a benefit to clients to sort of increase that part of the portfolio on this higher number, as the stock market does what the stock market can do. So,
right.
So that price of safety is definitely a motivator for us to increase the income producing part of the portfolio. We've always been sort of geared towards higher interest rates anyway. So again, it's a trend we were doing regardless, but there's added benefit to keep doing that when the price of safety is much, much higher now. Within the portfolios on the equity side, there's a few things that sort of are hitting our radar. We're kind of looking closely at industrial companies.
Mm-hmm.
So for all those reasons we just mentioned, the industrial companies, they've had a pretty good run, pretty strong run. So in some cases, our radar's up to watch future valuations. And in some cases, we're taking some profits off the table. But that's just one sector that's kind of got our radar up in terms of watching that. One step further from that is international equities. Again, we're just not seeing that flashing green light in that area yet.
Right.
At some point we will,
right.
But quite frankly, Europe's still in a mess. And, China opening up again is kind of a question mark, the war going on.
Yeah.
We're just lightening up on international equities at this time until we see that green light flashing. So
makes a lot of sense.
Yep.
Anything else, Joel, you want the listeners to know about in terms of what we're thinking?
No, I just sort of reiterate, I don't think it's going to be a straight line up from here. We're going to continue managing how we're doing. If there's one sort of message, it's going to be that we're continuing to play defense for the time being. We haven't flipped over to be offense, to use that sports analogy. But again, quality companies, they're going to be there through thick and thin, dividend payers, and again, our bond markets, that we're sort of use a pretty simple strategy that all the bonds are going to mature. So collect the coupons, as they say, until the bonds mature. And we'll steer the ship that direction. So
cool. Okay, Joel, thanks for this.
Thank you.
As always, folks, if you have any questions, don't hesitate to reach out to your CPA firm's advisor, wealth advisor, or obviously your portfolio manager as well. Take care, everyone.